studying your last two. I swim med when tunden. Det styr en namn to mute. And can learn the pole that sunk he died.
Everything we've learned so far leads to this moment. We've studied investment income, refundable tax, the RDTOH account, and Part 4 tax. But none of those refundable tax amounts are automatically returned to the corporation. The event that activates the refund system is the payment of a taxable dividend to the shareholders. Let's see how that works. Imagine that a corporation has already earned profits and paid its corporate tax. After paying that tax, the remaining after-tax profits stay inside the corporation as retained earnings. At this stage, the corporation may decide to distribute some of those retained earnings to its shareholders in the form of a taxable dividend. From the corporation's perspective, this is simply a payment to its owners. From the shareholders' perspective, it is dividend income that will later be reported on their personal income tax return. But something else happens behind the scenes. The moment the corporation pays a taxable dividend, it may become eligible to receive a dividend refund from the Canada Revenue Agency. This is because the refundable tax that had been accumulating in the corporation's RDTOH account can now begin flowing back to the corporation. Notice the sequence carefully. The corporation does not receive a dividend refund simply because it has an RDTOH balance. The corporation receives the refund only after it pays a taxable dividend. That's one of the most important concepts in this chapter. You can think of the dividend payment as the key that unlocks the refundable tax account. Without paying a dividend, the refundable tax remains inside the RDTOH account. Once a taxable dividend is paid, the refund mechanism is activated, allowing the corporation to recover part of the refundable tax it previously paid. A simple way to remember this concept is, no dividend paid means no dividend refund. Dividend paid means a refund may become available. As a tax preparer, whenever you see a corporation with an RDTOH balance, one of your first questions should be, has the corporation paid any taxable dividends during the year? If the answer is yes, you should expect the tax software to calculate a dividend refund, subject to the applicable tax rules. In the next slide, we'll follow this process one step further and see exactly how paying a dividend reduces the corporation's tax payable through the dividend refund mechanism. This is where all of the concepts we've learned finally come together into one complete tax integration system. Now let's see how paying a dividend actually reduces the corporation's tax payable. Up to this point, we've learned that the corporation may have accumulated a balance in its refundable dividend tax on hand, or RDTOH, account. Think of this account as a storage vault that holds refundable tax paid in previous years. However, simply having money in the RDTOH account does not automatically produce a refund. Something has to trigger it. That trigger is the payment of a taxable dividend to the corporation's shareholders. Once the corporation declares and pays the dividend, the Canada Revenue Agency reviews the dividend payment and determines the amount of dividend refund the corporation is entitled to receive. The important point is that this refund is not new money. Instead, it is a return of refundable tax that the corporation had already paid in earlier years. When the refund is issued, two things happen at the same time. First, the corporation's corporate tax payable is reduced because the dividend refund offsets part of the tax that would otherwise remain payable. Second, the balance in the RDTOH account decreases. This happens because part of the refundable tax has now been returned to the corporation. A useful way to visualize this process is with the water tank analogy. Imagine that the RDTOH account is a large water tank. Each time the corporation pays refundable tax on investment income, or Part 4 tax, more water flows into the tank. When the corporation pays a taxable dividend, It's like opening a valve at the bottom of the tank. Water begins flowing back out, representing the dividend refund received from the Canada Revenue Agency. As the refund is paid, the water level in the tank drops, just as the balance in the RDTOH account decreases. A simple way to remember the entire sequence is: the corporation pays a taxable dividend. The dividend refund is generated. Corporate tax payable is reduced. The RDTOH balance is reduced. Notice that everything begins with the dividend payment. Without paying a taxable dividend, the refund mechanism never starts. This is why tax planning often involves deciding when a corporation should pay dividends. The timing of those dividends can determine when refundable tax is recovered, improving the corporation's cash flow while maintaining Canada's tax integration system. The key takeaway from this slide is straightforward. Paying taxable dividends allows refundable tax to flow back to the corporation. As the refund is received, corporate tax payable decreases, the RDTOH balance is reduced, and the tax integration system works exactly as intended. This is the practical reason why understanding dividend payments is so important in Canadian corporate tax planning. Let's bring the entire chapter together by following one complete example from beginning to end. Imagine that a corporation earns investment income during the year. This income could come from interest, dividends, rental properties, or taxable capital gains. Because investment income is generally taxed at a relatively high corporate tax rate, the corporation pays corporate income tax to the Canada Revenue Agency. At this stage, not all of the tax is intended to remain with the government permanently. The refundable portion of the tax is recorded in the corporation's Refundable Dividend Tax on Hand, or RDTOH, account. You can think of this account as a running balance that tracks refundable tax available for future recovery. Now the corporation has a choice. It can continue retaining its after-tax earnings inside the business, or it can distribute some of those earnings to its shareholders by paying a taxable dividend. Once the corporation pays that taxable dividend, an important event occurs. The Canada Revenue Agency calculates the corporation's dividend refund based on the applicable tax rules and the available balance in the RDTOH account. As the refund is issued, part of the refundable tax that had accumulated in the RDTOH account is returned to the corporation. Because the corporation has now received a dividend refund, its corporate tax payable is reduced. At the same time, the shareholder who received the dividend reports that dividend on their personal income tax return and pays personal tax according to the personal tax rules. When you look at the entire process, you can clearly see Canada's tax integration system in action. The corporation initially pays tax on its investment income. The refundable portion is tracked in the RDTOH account. The corporation pays a taxable dividend. A dividend refund is received. Corporate tax payable is reduced. Finally, the shareholder pays personal tax on the dividend. This sequence helps ensure that income is taxed appropriately as it moves from the corporation to the shareholder, while avoiding unnecessary multiple layers of permanent taxation. As a tax preparer, there are several important points to verify whenever you review this process. Confirm that a taxable dividend was actually paid during the year. Verify that the dividend refund has been calculated correctly. Check that the RDTOH balance has been reduced appropriately. And finally, ensure that the corporation's tax payable reflects the dividend refund that was received. The key takeaway from this entire example is simple. The refundable tax system only comes to life when taxable dividends are paid. Investment income creates refundable tax. The RDTOH account tracks that refundable amount. Paying dividends unlocks the refund. Corporate tax payable is reduced, and the shareholder ultimately pays personal tax. This is the complete tax integration cycle. Once you understand this story from beginning to end, You've mastered one of the most important concepts in Canadian corporate taxation. Every advanced topic that follows, including the new RDTOH and NRDTOH rules, is built on this same foundation.